with looming uncertainty about the impact of Donald Trump's tariffs on inflation and the economy still elevated, the Fed is expected to leave its key interest rate unchanged for a fourth straight meeting later today. Meanwhile, Trump has aggressively called on Jerome Powell to sharply lower rates, citing the European Central Bank's aggressive rate-cutting campaign over the past year. And for more on today's Fed decision, let's bring in Sonola, U.S. Head of Economic Research at Fitch Ratings, and Lewenza still with us as well. Thanks very much for your time this morning. So it would be a surprise if the Fed did anything but hold pat for now. Give us a sense on what your expectations for the Fed are today.
No, that's clearly our expectation. We expect them to do nothing. It's very, very early in the game this year, given everything that's happened since April. So the data is going to be noisy. You can't trust what you're looking at now. So you're going to have to wait a couple of months to see what the data really looks like. Clearly, going forward, downside risk to employment, upside risk to inflation. You need to wait to see which one actually shows up first.
And if the Fed were to walk back rate cut expectations, how much of that is, would you say, priced into the market right now? In other words, people are not, on average, are not expecting the Fed to do anything today. But I still think that as you go into the latter part of the year, just because of some of the economic uncertainty that seems to be building, there does still seem to be a belief that it should not be a surprise for the Fed to actually cut interest rates later this year. So if they were to try to dial back those expectations, how do you think the market would respond to that?
It depends on the extent to which they dial it back. I think markets generally now expect, 2 rate cuts? We expect 1. So if the Fed goes ahead and the dot plot essentially shows a 1 cut, the market will be disappointed. We may see a negative reaction. If it goes to 0, which would be a big, big surprise, yes, we will clearly see a much more negative reaction, and the markets would not like it at all.
Hi, Olu. Ryan Lewenza here. Lots of concern. Hi there. Lots of concern, obviously, that Trump tariffs will start to show up in the inflation. We'll see a reacceleration, but we haven't seen it yet. It's maybe 2.5, 2.7 on a year-over-year basis. What's your expectation for the inflation? Do you think we'll see a ramp up? And if so, maybe when do you think we'll start to see it in the data?
We definitely think there will be a ramp up. We're in the 2 handle now, as you said. We see that moving into the 3s. It's good that we saw all of that de-escalation, and hopefully it stays that way. So based on where we are today, we're looking at those numbers creeping into the 2s. Now, when you now factor in, hey, there's still a lot of uncertainty out there. We don't quite know what's going to happen between now and July 9th. That's the end of the 90-day pause. We'll just have to wait. If it escalates, it's very, very unlikely. But if it does escalate, then you're probably looking at higher inflation. But if it stays around where it is now, then we think you're probably talking something around 100 basis point increase through the end of the year. And in terms of when it shows up, I would expect it to start showing up by next month, max 2 months from now. Yes, May, you really didn't see much of a sign of tariffs in it, but very likely from next month, say even August, I would expect it to certainly show up in the numbers.
Now, this is a very busy news cycle, and obviously we'll be watching any of the developments in the Middle East. Whatever the U.S. president has to say about that will be closely monitored. But of course, the president has also said he would name a successor to Jay Powell very soon. So traders who track Fed decisions are also trying to figure out what Jay Powell's tenure is going to look like, who might be the next person to lead the Fed, how any commentary from the president, maybe in reaction to what the Fed does or says, is also worth watching. As an economic researcher, how do you think about that part of the puzzle?
I think that's a wild card. We've never seen anything like that before, where you essentially have a shadow Fed president. Jay Powell's tenure essentially expires about this time next year. I believe it's May of 2026. So if we have an alternate Fed president or a shadow Fed president before the end of the year, it's going to be interesting because now what will that Fed president do or say? How will the market react to that? Will the market listen to that Fed president as opposed to Jay Powell? Or will the market just completely discount whatever that Fed president says? It's going to be very, very interesting. There is no precedent for it. My sense is that the market still does trust Jay Powell and the Fed infrastructure as it is, and will probably still continue to, look in that direction for policy direction. But clearly, a potential shadow president, a potential shadow Federal Reserve chair could undermine the credibility of Jay Powell.
And that concept of a shadow Fed president would be that Donald Trump names a successor so we know who that person is, and if that person does not remain silent and comments here and there, that creates a situation we're just not used to.
Exactly. And, it's one thing to name a Fed president, a potential Fed chair, and the person just sits on the wings and says nothing. It's another thing to name more or less an activist one that echoes whatever President Trump tweets or truths. So two very different dynamics. I think if he does select someone this year, way before May of next year, that may come as a signal that I want someone to start speaking on my behalf. But if he does wait till, say, March of next year, then I think we'll all be fine. But it's a risk. The Fed still has a lot of credibility. And the reality is, it's a consensus Fed. It's not one person that basically dictates what policy it's going to be. Whoever comes in is going to be one of 9 voting members, I believe. And, even if that person is very, very activist, very, very dovish, really wants to aggressively cut rates, it's probably not going to happen because at the end of the day, you're just one vote out of 9.
Hi, Olu. Ryan here again. Do you have an outlook on kind of the longer end of the curve, kind of the 10, 20, 30-year bond yields? Obviously, we've seen a lot more volatility, lots of concerns around this one big, beautiful spending bill that's going to add an estimated $3 trillion to the debt. So we are seeing some concerns around, longer-term bonds. What's your outlook there?
Yeah, we've seen a lot of volatility, as you rightly said. We still are looking at around where we are as the near-term outlook, so 4.5, give or take. Lots of concerns about fiscal trajectory, as you said. Lots of concerns about policy uncertainties on the trade side, and lots of concerns about the dollar. But, after it's all said and done, we're still looking at the 10-year at around 10. The 10-year at around 4.5. And that's where we think it's going to be for quite some time. You're going to see volatility around that estimate, but we think ultimately that's where it settles.
And actually,
over the near term.
That's really helpful. And actually, I'll just ask a quick currency question as well, because as you know, just in light of the situation here in Canada, we actually have seen a fairly strong Canadian dollar against the U.S. dollar recently. I think the Bank of Canada's cautious tones in the minutes from their most recent meeting made some people wonder if that is tenuous. So I guess my question to you is the U.S. dollar itself, given everything you've been talking about, how are you thinking about how people might be positioning within the U.S. dollar?
That's actually one where we'll not know what's really going on for couple of months. The concrete data on that lags in terms of who's holding the dollar, who's diversifying out of the dollar. Are you talking about private investors, private international investors? Are you talking about central banks, international central banks? We don't quite know that yet, but we'll get to find out. I think the alarm is if the dollar is declining for the wrong reasons. Generally, if the value of the dollar is falling, it's actually not that bad for U.S. manufacturers because you can export more, and because large corporations in the U.S. have a significant chunk of revenues from overseas, I believe about 40%. Mm-hmm. If that money is coming in, it's a lot more dollars for companies' bottom line. So it's not technically bad. And when you also take a slightly longer view, the dollar is still pretty strong. Yes, we've seen it come down about 10% year to date, but it's still very, very strong. If you continue to see the decline, then it starts to become a problem because you're thinking, okay, are people actively diversifying away? But what I would say is the wrong reason, for lack of faith, for the sell US sort of mantra. Then you start to think about the long-term consequences. But thus far, it's still not quite showing red. I would probably say yellow at this point. And if it stays where it is, I think we'll be fine.
All right.
The main issue is if we have that disorderly decline or continued decline in the